Welcome to Accounting with Professor Lamptey. In our previous lessons, we have been building the accounting cycle step by step. We talked about cash basis and accrual basis accounting, adjusting entries, and financial statements. Now we are ready for the next step, closing entries. Closing entries come after the financial statements are prepared. Adjusting entries help prepare the financial statements. Closing entries help prepare the accounts for the next accounting period. And I know what some students are thinking. Professor Lamptey, we just finished adjusting entries. We prepared financial statements. Can we not just rest? Not yet. Accounting is not finished until the accounts are ready for the next period. Think about it this way. At the end of a football game, the score is final. The winner is known. The statistics are recorded. But before the next game starts, the scoreboard must be reset to 0. You do not begin the next game with the old score still showing. Accounting works the same way. At the end of the accounting period, we measure revenues, expenses, and dividends for that period. Then we close those temporary accounts so the next period can begin fresh. So here is the simple idea. Closing entries are journal entries made at the end of the accounting period to reset temporary accounts to 0 and transfer net income or net loss to retained earnings. During the year, a business records revenues, expenses, and dividends. These accounts measure activity for a specific period. Service revenue tells us how much the business earned during the year. Rent expense and salaries expense tell us what the business incurred during the year. The problem is that these accounts are not supposed to keep adding forever. If a company earned $50,000 of revenue in 2026, we do not want that same revenue sitting in the revenue account when 2027 begins. Closing entries separate one accounting period from the next. Temporary accounts are accounts that measure activity for one accounting period. They are closed at the end of the period. The main temporary accounts are revenue accounts, expense accounts, and dividends. For a sole proprietorship, you may see owner's drawing instead of dividends. Permanent accounts continue from one period to the next. They are not closed at the end of the period. These include assets, liabilities, common stock, and retained earnings. Cash is not closed. Accounts payable is not closed. Retained earnings is not closed. This is very important. Temporary accounts are closed. Permanent accounts are not closed. Revenue, expenses, and dividends are closed. Assets, liabilities, common stock, and retained earnings are not closed. That is the foundation of closing entries. To close an account means to bring its balance to 0. If an account has a credit balance, we debit it to close it. If an account has a debit balance, we credit it to close it. Revenue accounts normally have credit balances, so we debit revenue to close it. Expense accounts and dividends normally have debit balances, so we credit them to close them. Many textbooks use an account called income summary. Income summary is a temporary clearing account used during the closing process. Think of income summary like a basket. At the end of the period, we place revenues into the basket. Then we place expenses into the basket. What remains is net income or net loss. In introductory accounting, we usually teach 4 closing entries. First, close revenues to income summary. Second, close expenses to income summary. Third, close income summary to retained earnings. Fourth, close dividends to retained earnings. The first closing entry closes revenue accounts. Revenue accounts normally have credit balances. To close a credit balance, we debit the revenue account and credit income summary. Assume the company has service revenue of $50,000. The closing entry is debit service revenue, $50,000, and credit income summary, $50,000. This reduces service revenue to 0 and transfers the revenue amount into income summary. The company did not lose the revenue. The revenue was measured for the period and moved into the closing process. The second closing entry closes expense accounts. Expense accounts normally have debit balances. To close a debit balance, we credit the expense accounts and debit income summary. Assume salaries expense is $20,000. Rent expense is $10,000. Utilities expense is $3,000. And insurance expense is $5,000. Total expenses are $38,000. The closing entry is debit income summary, $38,000, and credit the expense accounts for their individual balances. After this entry, the expense accounts are reduced to zero. The expenses have been transferred into income summary. Now, income summary contains both revenue and expenses. Revenue was $50,000. Expenses were $38,000. Net income is $12,000. Since income summary has a credit balance of $12,000, we close it by debiting income summary and crediting retained earnings. Net income increases retained earnings. That is why we credit retained earnings when the company has net income. But if expenses are greater than revenues, the company has a net loss. A net loss decreases retained earnings. The fourth closing entry closes dividends. Dividends are distributions to stockholders. Dividends are not expenses. They reduce retained earnings, but they do not reduce net income. Assume the company paid dividends of $4,000. The closing entry is debit retained earnings, $4,000, and credit dividends, $4,000. Let's put the example together. The company had service revenue of $50,000, total expenses of $38,000, and dividends of $4,000. Net income is $12,000. Retained earnings increases by net income of $12,000 and decreases by dividends of $4,000. So the net increase in retained earnings is $8,000. After closing entries are posted, the company prepares a post-closing trial balance. The post-closing trial balance lists only permanent accounts. You should not see revenue accounts, expense accounts, or dividends because those accounts have been closed to zero. Let's avoid common mistakes. Do not close permanent accounts such as cash, accounts receivable, equipment, accounts payable, common stock, or retained earnings. Do not treat dividends as expenses. Dividends reduce retained earnings, not net income. Also remember that closing entries do not affect cash. They reset temporary accounts and update retained earnings. Let's recap. Closing entries are made at the end of the accounting period, after financial statements are prepared. Their purpose is to reset temporary accounts to zero and prepare the accounts for the next period. The four closing entries are: close revenues to income summary, close expenses to income summary, close income summary to retained earnings, and close dividends to retained earnings. Adjusting entries make the numbers right. Closing entries reset the temporary accounts. Thank you for watching Accounting with Professor Lamptey. Learn accounting, think critically, make better decisions. I will see you in the next video.